Welcome back to Alpha Recap. Kristen here. We're unpacking the day's biggest market themes and what moves stocks after the close. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Thanks for having me.
So James, quick overview. Today felt like a story about resilience and execution. Medtech and retail tech on one side, big battery projects and community solar on the other. And then the usual retail-driven microstructure fireworks. Tell us what jumped out to you first.
What really stood out was the way digital readiness is being reframed. Deloitte ran a survey of industry execs, and it suggested that firms with digitally enabled recovery plans actually recovered faster and reported better financial outcomes. That elevates digital programs from cost centers to strategic levers. Right, and the study also flagged gaps, governance and cyber readiness in particular, where medtech firms could be exposed.
Hold on, say that again. Gaps in cyber and governance in medtech?
Exactly. In plain English, some companies have the tools to recover from a supply chain shock quickly, and some don't. The ones that don't face higher execution risk and more volatile earnings.
When you step back and look at this, that's a pretty big investor consideration.
Absolutely. Analysts are already pointing to names with complex supply chains. Medtronic, Stryker, and Boston Scientific were referenced as ones where digital recovery capacity could materially affect margins.
So this isn't just an IT checklist. This could show up in earnings.
Yes, companies that can demonstrate shorter recovery times and stronger cyber governance may show differentiated margin resilience. Conversely, public disclosure of gaps could translate into higher perceived risk.
And on the retail side, Home Depot named a new chief technology officer, which seems related.
They did. Home Depot said Dr. Franziska Bell will be Executive Vice President and Chief Technology Officer effective April 6th. That signals a potential acceleration in how big box retailers digitize forecasting, fulfillment, and vendor integrations.
Right.
And to add to that, when a retailer of that scale changes the technology leadership, suppliers and logistics partners tend to face higher demands for integration and performance metrics.
So both stories point to digitization as a competitive differentiator across sectors.
Yes, same structural trend, different industries. Investors are starting to ask for disclosure around timing, spend levels, and key performance indicators for digital recovery and cyber programs.
Okay, switching gears to energy. Big milestone today out of Georgia.
Georgia Power broke ground on a 260 megawatt battery energy storage system near Wadley, Georgia. Groundbreaking means the project moved from approvals into execution, which is a meaningful step for grid-scale storage.
And just to be clear for listeners, 260 megawatts is a material addition at the utility scale.
Exactly. Storage like that helps manage intermittency and peak demand. From an investor or utility perspective, the watch items are capital deployment, construction milestones, and the commissioning timeline. That's when the asset will start contributing to capacity markets or revenues.
Powerbank also had news on community solar in Pennsylvania, right?
They provided an interconnection update and suggested the project could be among the first community solar developments of its kind in that state. Early projects set precedents for grid access and regulatory expectations.
So utility-scale storage and community solar are kind of complementary moves in the energy transition.
Yes, storage smooths supply, community solar expands local generation. Together, they support grid resilience and broaden participation. But execution risk, CapEx phasing, and supply chain pressures will be key variables to watch.
Let's talk market microstructure, because, wow, there was a lot of retail-driven action today.
Indeed, we saw a small cap that finished the day up about 3% to roughly $8.52 on heavy volume, about 125 million shares. Separately, a triple leveraged short exchange-traded fund rose about 4.5% to about $7.84 on roughly 156 million shares. And a penny stock name plunged down about 4.5% to around 2 cents with outsized volume, about 267 million shares.
Not a great day for thinly capitalized names.
No, and those moves illustrate two dynamics. One, heightened retail participation and momentum trading can move thinly capitalized names rapidly. Two, leverage amplifies risk. Instruments that are triple leveraged can swing drastically in a single day, which changes exposures fast.
Right. Execution risk, wider spreads. That can hurt traders and market makers alike.
Exactly. If volume spikes persist without news or filings to justify them, that's when liquidity and risk management questions show up for active managers and brokers.
Quick reality check. Did markets close strongly overall? Or was this more of a story of idiosyncratic moves?
It was more idiosyncratic. Intraday action was shaped by these company and sector level headlines rather than a broad market swing. So we saw pockets of volatility rather than a market-wide re-rate. Yeah, that tracks.
Let's touch on analyst signals and M&A. There was an analyst note on Winnebago and a middle market sale that closed.
D.A. Davidson lowered its price target on Winnebago, flagging macro concerns in discretionary categories. The summary we saw didn't include the new target or full rationale, so market participants will want the full note to understand the assumptions.
And the private market deal?
A middle market company called Andessa was sold to Terminus Capital Partners, with Butcher Joseph acting as exclusive advisor. No purchase terms were disclosed. That kind of activity underscores that private capital deployment remains active even when public market sentiment is cautious.
Also, a small leadership promotion at a consulting firm made the briefs. In Thought Research promoted Dr. Amanda Weyerbacher.
Promotions may not make headlines for most listeners, but in niche consulting circles, they can matter for client retention and delivery speed, which in turn affects revenue timing.
Quick reactions. What's the overarching pattern coming out of today's briefs?
3 patterns. 1. Digitization is increasingly a differentiator, not just a cost line, but an operational and earnings lever. 2. The energy transition is moving from permitting to construction, especially for grid-scale storage. 3. Retail flows and leveraged instruments continue to produce episodic volatility.
So, what really stands out here is the emphasis on execution, whether that's digital programs or physical construction.
Yes, execution and disclosure. Investors are going to want timelines, CapEx phasing, and measurable KPIs, both for digital programs in medtech and retail, and for clean energy projects coming online.
Let's do a quick checklist of what to watch next, like tomorrow's catalysts.
Look for several follow-ups. Deloitte releasing deeper data or commentary on the Medtech survey. Home Depot communications after April 6th that outline the new CTO's priorities and budgets. Progress updates from Georgia Power on construction milestones and CapEx pacing for the 260 megawatt battery, and any interconnection approvals or construction starts for the Pennsylvania Community Solar Project.
And on the microstructure front,
watch whether price and volume follow-through occurs in those names that spiked today. Persistent flows would suggest a trend. Quick reversals would imply episodic chatter. Also, keep an eye out for D.A. Davidson publishing the full Winnebago note so we can see assumptions and magnitude.
Okay, 2 more quick things before we wrap. Any surprises you'd flag?
Honestly, I was a bit surprised by how explicitly Deloitte tied digital recovery to financial outcomes. It's not been framed that way so directly in many prior public studies.
Right. That could shift how investors evaluate operational disclosures.
And from the energy angle, groundbreakings like the Georgia Power one are important because they show projects moving into capital spend. That's where revenue timing and risk become clearer.
Got it. Final quick takeaways? Hit us with the headlines in 1 sentence each.
First, Digital recovery and cyber governance are becoming measurable drivers of resilience and may influence margins in medtech and big retail. Second, the clean energy transition is shifting into execution phase, with grid-scale storage breaking ground and early community solar projects progressing. Third, retail-driven volume and leveraged ETF flows remain a source of episodic volatility that can distort short-term price action.
Perfect. Anything listeners should be cautious about?
Just a reminder, this is analysis and not personal investment advice. Analysts note these themes and data suggest potential implications, but everyone's situation is different and professional advice is important.
Thanks, James. Really useful summary.
My pleasure.
That's our recap for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll see you next time.